Hello and welcome. I'm Kavita Thapliyal and you are watching The Money Show, and in fact you're watching our very special coverage on National Nutrition Week, and we are going to talk about nutrition for your wallet, just like how we'll be doing on the other days in the entire week. And today one of the very important nutrition dose for senior citizens and their financial planning. So on today's show, and as per the lineup that we have for you on the Nutrition Week, we'll be focusing on financial planning for senior citizens and post-retirement financial planning for them. And various aspects, right from investments to insurance to your financial liabilities, and a very important aspect of getting your wills done and your inheritance done will be a part of this financial planning session. And to guide our viewers and to take them through all of this, today I have with me Dhruv Mehta, Chairman of Federation of Independent Financial Advisors. Dhruv, good evening and welcome to the show. Very important aspect, and financial planning, although is a strategy that one should be adopting right, from a very early age, or whenever they think about their financial goals, that's the time when they have to think about a financial strategy. But this particular discussion is about senior citizens and post-retirement planning. I want to understand from you, as a thumb rule, what should be the right age to think about your retirement and also plan your life post-retirement. Early on in the age, what happens is people want to plan about their kids' education, their marriages. Retirement often comes post 40 or even after that, especially if you have financial liabilities on you. So, you've been in the business since such a long time. Where do they go wrong, according to you, when we talk about retirement planning through?
I think most people go wrong is they don't plan for retirement. And as you said, maybe very early, you have a lot of other interests. When you're very young, it's very difficult to think about retirement. So, but even somebody in the age of 35 to 40, at least that's I would say, the latest age by which you should look to, start planning for retirement, because that gives you a good runaway of the next, if you're going to work till the age of 60 or 65, that you can, save money and create a corpus based on which you can retire. So I think what I found is that most people do not give enough thought of retirement even at the age of 35 to 40.
That's surprising because traditionally, when we talk about putting in your money, investment instruments like a PF or a PPF, or having an insurance cover, these things are usually on top of their mind, and all of these things are attached to retirement or that retirement goal. So, are we also trying to say that even if people are aware about this particular financial goal, maybe they are not rooted through the right investment instrument? Is this right to say?
Yeah, very right. I think while instruments like PF and PPF do, enable compulsory savings, but they really do not, help in terms of fighting against inflation. They just barely keep up with inflation. So some component of an equity investment is necessary, and therefore, the earlier you get in, the better is the prospect of that. You have a corpus which is decent enough to especially meet the inflationary needs. Your expenses keep growing up with inflation as time goes, and equity is the only asset class which really instrument to fight inflation, but you
All
need to
right,
give
so
it a good
sure.
time.
That's very important. And over here comes the right dose of nutrition for your retirement goal. Okay, so this question maybe you can answer in two parts. You can talk about the corpus that one needs to accumulate till retirement, and then later on a different strategy that's needed to live your life post retirement. So, the nutrition that's needed till the time you have to accumulate that corpus by the age of 60, and then the kind of nutrition that's needed to live your post retirement life through.
So I think when you look at nutrition, I think, if you were to compare with that, one needs to have a balanced diet. You can't be having only sugar, or you can't be having only salt. You need a mix of protein, carbohydrates. So I think in terms of investments also it's very important that you have a balanced portfolio. Now, how do you balance the portfolio? It is depending on your needs, just as, the food that one needs is based on, your individual routine and fitness. So similarly, I think in the early stage when you're in the accumulation phase, you need to invest into assets like broadly, if you have to divide between debt and equity, equity is an asset class which gives much higher returns than debt, but it has a huge volatility. That is, in the short run, equities can be subject to a lot of fluctuations. They can correct in the short run, and they could correct as much as 20%, 30%. But if you're a regular investor, a regular saver, you are constantly putting money away. So it becomes appropriate for you in the accumulation phase to invest into equities. Then, when at the point of retirement, what would happen is that your regular income would stop and you would need to start having some regular cash flows. So I think the planning post retirement is very important, that your portfolio is balanced in a way that some portion of the money is regularly coming out so that you can meet your regular expenses. Some of your expenses could be monthly, some of them could be annual, like you might want to travel, you might want to go on a holiday, and some portion you need to keep for sort of emergencies and medical contingencies. So post retirement, you need to see that your portfolio is adequate or appropriately structured, so all these requirements can be met.
But because we are talking about retirement, and these days, the concept of retirement, Dhruv, has also changed. Retiring at the age of 60 is no more a concept. It's not a mindset anymore. People want to retire early. And also, retirement doesn't mean that you will not have income or you will not have any other income source. Normally, it also means that you will stop doing a job, and maybe you'll be having a second inning in your life, and maybe entrepreneurship, which is the trend these days. A lot of people are also quitting their job and getting into the gig culture where they don't have a steady income. So there is no defined concept of retirement anymore. What will be your suggestion for all of these people who want to retire early, who believe in making money through gigs? Maybe they have an investment plan in mind, or they don't have, but there is no steady income and there is no clear-cut direction towards retirement. That's a very gray area. How do we help them?
So I think there I think the concept becomes, financial freedom. Let's say you're 30 years as somebody at the age of 30, but who would like to have the freedom that the age of 40, he need not continue with a sort of a fixed job. He has the flexibility to, start something entrepreneur, or maybe, as you said, a gig job or something where he's as a consultant. So I think what is important is to determine the amount of corpus that you would need to be financially free. And how does one determine the amount of the corpus that you need for financial freedom? Again, would turn down to as to what are your basic necessities, what are your living expenses, basic stuff where and what is the amount of corpus needed for that, so that you're not worried about running your household expenses. Correct, you have created a corpus from which you can manage your household expenses, and that allows you the freedom, to explore any entrepreneurial role that you want to start. So from the starting date, that is today, till the date that you wish to create this sort of a roadmap, over a period of 5, 10 years, you need to determine what is the amount of expenses that you will need at that point of time, and what is the corpus that you will need, so that you are free to take on any other uh, professional assignment or entrepreneurial role.
All right, let's talk about the strategy which comes in the second phase of your retirement, which means that when the stage where you have to take money out of your investments. obviously, a lot of trust has to be given to insurance because that's something you should be having at the right age, and you should be continuing till retirement and even post that. So that is one very important aspect of financial planning that one should be considering. But having said that, now post-retirement strategy, how can one align that? Very important to finish off all your financial liabilities well before you decide to retire, or you get to know that you won't be having any other source of income and have to really rely on that particular investment portfolio. But how do we use that investment portfolio? Because we also need to protect our capital. At the same time, we have to make sure that our investments are growing because we are withdrawing every month from that investment portfolio. So,
Right. So I think one is to keep in mind a simple rule that you should be withdrawing about 4 to 5% of your corpus every year if you want that corpus also to keep growing in line with inflation. What happens post retirement? So that is the amount of corpus that if you create, that if your expenditure and all the needs that you have is say 100 rupees, then you multiply by 25. That's the amount of corpus that you need. Effectively, that is, you withdraw 4% of the corpus every year, and you create a portfolio. Today, you have, say, simple instruments like mutual funds from which you can start a systematic withdrawal plan. So, based on the amount that you want to withdraw every month, you can give a standing instruction, and every month you will have a regular cash flow coming out of it. So, I think that is one of the sort of simplest method that we advocate to our clients, that you build up a corpus and you get into a systematic withdrawal plan so that all your sort of monthly expenses are taken care of.
uh, so Dhruv, what kind of asset classes you should be having your exposure in? Talking about the SWP phase, how much in equity and how much in debt? What should be the proportion according to you?
So the proportion again comes down to uh, how much is your expenses, and what we advocate that uh, to start with something like 2 to 3 years of your expenses should be kept into a sort of a liquid fund or a debt fund, so that that money is available on tap. And thereafter you can look at retaining a large component into equity. Now this depends on how you have built up your assets. If you have built up over a very long period of time, and therefore in the beginning when I said in the accumulation phase, uh, you are investing in equities, and if you build up the corpus over a 10-20 year period, that money which is lying in equity can remain in equity, but you pull out at least something like 2 to 3 years of your expenses from that into a debt fund or a debt product, because that ensures you have enough safety and liquidity in case the equity markets correct. The remaining portion can continue into equity, and from those equity funds, you start withdrawing money. Correct. So the composition of the asset allocation would again then depend on the investor's risk profile. Is he very worried? Is he very concerned? Is he able to withstand short-term volatilities of the equity market? So then it would get into individual personal assessments, risk profile of the person, his other circumstances, and broadly a combination of equity and debt. And today you have products where the combination is already available. There are funds which are a combination of equity and debt, and in different proportions. So assessing the investors' preferences, his needs, and it becomes a very individual planning as to the actual, asset allocation, the proportion between equity and debt.
I think we definitely need more time to discuss more on this, Dhruv, but then that's all I have on this show today with you. Thank you so much for being a part of this particular discussion and helping our viewers navigate through their very important retirement goal. Thank you so much.
Thank you. Thank you.
All right, but then But then it's not the end of the show. Let's get on to the live viewer queries part. And for that, today I have with me Gautam Kalia, Senior Vice President and Head Super Investor at Sharekhan by BNP Paribas. Gautam, good evening and welcome to the show. And let's begin with our viewer query session. Let's take Shashwata Haldar's question. He's 21 years old. He's investing 15,000 per month by SIP. And he wants to know if there are any changes needed in his mutual fund portfolio. He's doing SIP in Parag Parikh Flexi Cap 4,500, HDFC Mid Cap Opportunity 3,000, HDFC Flexi Cap 4,000, and HSBC Value Fund 3,000. So I don't have him on the phone line, but congratulations. You know, at the age of 21, he's thinking about investment and taking a route via mutual funds. This really shows how aware he is about his financial plan and his financial life overall. So congratulations, and Shashwata, just keep it up. But yes, let's talk about your fund mix. Gautam, I think he's played really well.
Yes, absolutely. And, I wish I was that smart at 21, starting with such a fairly large ship amount. I can already
Yeah.
think what the compounded value will be like 20, 30 years from now. So that's fantastic. When I look at his portfolio, just just a fair, one main point to address is that large cap bias needs to be built in more. So what I would say is that he's got Parag Parikh FlexiCap as well as HDFC FlexiCap and HSBC Value. So these three funds, I would say that he needs to reduce his allocation to these three funds because combined they represent about 77% of the monthly allocation, and move that money into more on the large cap side. So Parag Parikh FlexiCap he should reduce from 4,500 to 2,000. HSBC Value Fund he should reduce from 3,000 to 1,500, and this additional funds that he's left with, which is 4,000, should go to ICICI Prudential Blue Chip Fund. HDFC FlexiCap Fund should be reduced by 2,000, and that should go into Bandhan Core Equity. So then you have some more large and mid cap exposure there. So that's how I think the portfolio should be modified for a more long-term wealth creation standpoint.
All right, sure. Let's move on and let's take up Sneha's question. She's calling us from Nasik. Sneha, good evening. Hi, thank you so much for sending us your question.
Good evening.
Hi. Okay, so you want to invest 10 lakhs for 10 years for retirement corpus, is that right?
Right, right.
All right, and what's the corpus amount that you want to accumulate?
Well, whatever is the highest amount I can with that, I left that option open that, the experts could suggest whatever are the best, maybe top 5 mutual funds that I
Sure.
can invest in, where I can get the good amount with some sort of protection because, it's a retirement corpus. So it shouldn't be
Sure.
very high risk, investment.
Okay. Okay, so one question. You are 33 now. You want to retire at 43, is that right?
I don't know. You've got my age wrong. I'm 53.
You're 53. Okay. All
Right.
right. So, after retirement, are you depending on this investment portfolio entirely?
To a large extent.
Okay. So, what's the amount that you would be needing every month from this particular portfolio? I just want to arrive to a corpus so that we can decide
Yes.
as to how will you, manage your regular expenses otherwise.
Okay, so maybe around 20 to 30,000 maybe. I don't know if that's possible. You need to
Sure.
guide me on
Sure,
that.
exactly. So accordingly, we'll do the maths and then we'll arrive at a figure. So let's assume 30,000 per month after 10 years from now at the age of 63. And 10 lakh, that's it. You don't want to do any SIP. It's just one time 10 lakhs that you want to put. And that's it for this particular goal. Or you also want to do an SIP every month. Sneha?
Now I do not have
Sneha?
any investments in mutual funds, right?
Sure.
So 10 lakhs,
Right.
I can, since I have this amount with me right now, and if it's giving me good return, then I would definitely like to invest the entire amount right now.
So for you, the definition of good return would be the amount of corpus that you need after 10 years, which is your actual retirement requirement. Okay, so let's decide the good return part in that way. Gautam, I think this will be helpful for you to plan her financial goal, which is of a retirement, and after 10 years. So far, 10 lakh is what she wants to park in, and she's open and willing to do an SIP also. But I want to know from you a calculation. How much should be the corpus amount so that she can have what? 30,000 every month in her portfolio, every month for regular expenses from her portfolio. Gautam.
Yeah, so the I can use a couple of thumb rules right now. So 30,000 rupees every month means 3.6 lakhs a year, and let's say you're withdrawing from your portfolio at the rate of 7%. So you're looking at something like 50 lakhs. Your portfolio value should be. So that you can withdraw at the rate of 7% from the portfolio, assuming that your portfolio is able to generate a return of 10-12%. So that way you are growing your portfolio to adjust for inflation, at the same time being able to withdraw 7%, which translates to about 30,000 rupees every month. So if you're looking at building a 50 lakh portfolio, then 10 years, any investment growing at 12% a year, 10 lakhs is obviously on the lower side. So you start with 10, and then you try to build it up to reach 50 lakhs over the next 10 years. So for that, you'll probably have to put in another 10 to 12 lakhs, either in the form of SIP or in the form of lump sum as and when you get it. So what I would suggest, Sneha, that you do is that you build up, like a starter portfolio right now, and then you try to add to it on a monthly basis, whatever is convenient. And obviously, this is an ongoing journey. This is not a one-time conversation that you should have and then just forget about it. It's an ongoing journey. Financial planning, you should have a follow through and see whether you're on track to achieving your goals. So what I would say is, put in a startup portfolio, like have a 30% allocation to ICICI Prudential Chip Fund, 10% allocation to Bandhan Core Fund, Core Equity Fund, which is a large and mid cap fund. Mere Asset Mid Cap and HSBC Small Cap, you can put in about 25% there, and the remaining 35% allocation you can make to HDFC Flexi Cap and Kotak Flexi Cap. So that is your 100% allocation deployed, 10 lakhs deployed into pure equity. If you're looking for safety, then we have to introduce debt. We have to introduce multi-asset products in the mix. But right now, because you're looking at, let's say, growing from 10 lakhs to 50 lakhs, you'll probably have to take it a little bit more aggressive. If you're not comfortable with that, then I would suggest that you can probably introduce an HDFC multi-asset allocation fund in your portfolio and increase the allocation to that fund depending on how much aggression you want. So if you want more aggression, then keep the allocation lower. If you want more stability, then build up more allocation to hybrid funds or multi-asset allocation funds in your portfolio.
All right, Sneha, hope that answers all of your questions. All the best.
Yes.
Let's move on and let's take up Mr. Sumanta's questions on the phone line with us. Hi, good evening, sir. You're calling from?
I'm calling from Kolkata.
Kolkata.
Good evening to you.
Good evening, sir. Good evening. So you're looking at a monthly pension of 1.5 to 2 lakh via SWP from Jan 2031. Okay,
Right.
so you've given us your entire portfolio. Thank you so much for giving us all the nitty-gritties in a very elaborate way. Is there anything else you want to add so that I can directly go to Gautam and start your financial planning or the requirement that you've asked for?
So, ma'am, just, I had some equity portfolio also, and there I had almost 95% large cap. That is why in my mutual portfolio, I have taken a little bit more liberty on mid cap and small cap. And I've given my present, probably I have around 1.66 lakh SIP, and I've given my goals also, which are goals and which year I need this bond.
Very clear.
Just wanted
True.
to understand any changes I need in the SIP or anything else.
Sure. All right, so let's get it checked. Gautam, looking at his financial goals and the investment strategies he's adopted, what changes would you recommend?
So first, I'd just like to say that it is a proper financial plan. There's a lot of information here, so I'll try to do justice to the exchange of information here in this format. There are a lot of goals to achieve, and the total corpus that you require adjusted for inflation is close to 6.5-7 crores. And the value of your current investments along with SIPs will reach about 5.8-5.9 crores. So there is a slight gap for you bridge. This is all assuming your investment growth at 12% annualized. So if you can increase your SIP by another 70,000-80,000 rupees per month, then you'll be able to bridge that gap of about 1 crore between your your target goal amount as well as your current trajectory of your growth. As far as your schemes is concerned, again I would say your Canara Emerging Equity Fund, we prefer Bandhan Core Equity Fund as the same category. So you could shift that. Your Access Mid Cap, we prefer Kotak Emerging Equity. You could shift that. Access Small Cap, you could shift to HSBC Small Cap. SBS Small Cap, you could shift to Nippon India Small Cap. Otherwise, all the other funds look good. You've got enough aggressive hybrid and dynamic asset allocation. Also, you've got exposure. So I think otherwise the portfolio looks good. These are the changes that I would suggest as of now. But I'm glad to see such a robust approach and plan. Clearly done a lot of homework.
Definitely. So, Manta, is there anything else you want to ask Gautam?
No, I just wanted to understand, sir, when you have given this suggestions and when you said that another 70,000 you have to add, so I'm assuming you have taken that equity portfolio also into consideration, then also you feel I'm falling short, right?
Sure. Gautam?
Wasn't clear to me. The voice was muffled. Could you just
Could you repeat? Yeah, even I couldn't hear exactly. Sumanta, could you please repeat your question?
Sure. So I was trying to understand, when you are saying that 70,000-80,000 per month, if I add SIP, then it will not fall short of my target. I'm saying when you say that, is it that equity, whatever I have around 80-90 lakhs portfolio, is that taken into consideration too, or you only considered SIP and said that SIP and mutual fund?
No, I've considered your entire portfolio here.
Okay.
The information you shared with me in its entirety, right? Yes, yeah, I've included everything.
Okay.
All right, thank you so much, Sumanta, and all the best with your investment planning ahead. And with that, it's a wrap on the show. Thank you so much, Gautam, for taking time out and doing a live financial planning session for our viewers today. And before signing off, I'm going to leave our viewers with our WhatsApp number and email ID so that if in case you want to connect with us and across your financial portfolio queries, do that on our WhatsApp number, which is 8657974571. The email ID is themoneyshow@etnow.tv. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.